Good afternoon and welcome everyone to today's US market updates and our fourth quarter earnings review presentations. Great to see many of you on our webcast. My name is Kelly May, Associate Portfolio Manager, and here with me today are Fortrend CEO Joe Forster, along with our portfolio managers Chris Wallerman, Stephen Lyle, and Andrew Corcoran. We welcome question and answers throughout the presentation. Please feel free to click on the question and answers tab at the bottom of your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. With that, I'll now turn the presentation over to Joe.
Thank you, Kelly. Well, good afternoon. We've had a great run in the market. The primary issue here is that a quarter ago, we wrote about there being three risks affecting the market, being COVID, the election, and a stimulus package, fiscal stimulus. And of course, those risks have fallen substantially and the market has risen substantially. Since we last published, of course, we don't publish on the first week of January. I do 11 editions a year. So the performance is from the beginning of December. The market's up 6.8%, and we rolled forward for about 2/3 of the companies to December 2022 earnings estimates. So EE22 is the earnings estimates for the year ending, fiscal year ending December. Not all companies have a December year end, so we're not going to have 500 roll forwards, but we did have a 15% increase in forecasted earnings using to the new estimates over 2021, bringing the price earnings ratio down. So the price is up and the earnings are up more than the price. So the price earnings ratio has gone down to below 20. The 10-year treasury yield has increased from 0.84% to 1.17%, reflecting increased expectations for economic activity, but not creating concerns about inflation. There's been some debate going on in Washington between Powell and Yellen about the impact of the stimulus on inflation. I think that's just nonsense. It's not worth talking about at this stage. We still have technology bringing costs down around the world dramatically. I think the bigger risk has got to be deflation. Second quarter earnings were full of surprises. So I think it was when I think it was in the June edition where we wrote about rapid shifts in the economy, or the rate of the velocity of creative destruction. I think it was the budget office referred to it as rapid shifts, or the rapid change in things, and how the economy is shifting towards a COVID stay-at-home economy. In December, Trump's stimulus wore off, and he was going to try and get something through, but he didn't, and the economy slowed down a bit in December. But now the new Biden stimulus is being factored into the market as something that will create sustainable growth in 2022. So the change and I don't know that that's going to be as sustainable as the market thinks right now. So I think there is a risk that maybe the Biden stimulus and the $1,400 checks may not be as sustainable as the market thinks it is. So I think the market might got a little bit ahead of itself on that, but it's not important for $1,400 is not important when you think about Google and Apple and the FANGs and all the other leadership in the economy. The relative value model returned more than 13% during the period. Viacom finally went on a run. Viacom up some 50%, and Goldman Sachs went on a big run. So we outperformed the market substantially during the period, and we sold Amgen at a high. We just picked the absolute high on that. We made 17% in 4 months. And we went in to Exxon'S yielding almost more than 7.5%, and it's still half the price it was a few years ago. So we bought Exxon'S, and I think it's since we bought it maybe 5%. So it's some good trading in there, which we're quite pleased with. Major movers in the market. There've been, as I say, the big surprises in the market. On the upside, what we've seen is this what people are over mediating about there's the right word. The media's got like froth over this Robinhood analysis where GameStop and BlackBerry and maybe Viacom have been subject to some short covering, pushing those stocks up above where they should have been. BlackBerry is up on some of this short covering. Baidu is a recovery, and Baidu is one of the stocks that you own, and it's one of the BATs, the three Chinese companies that are similar to the FANGs, the Facebook, Amazon, Netflix, Google, and Apple, Amazon, Apple. So Baidu, Alibaba, and Tencent make up the BATs, and Baidu has had a great period. We've also had a great result out of some hospital stocks. So Tenet is a hospital company out of Dallas, Texas. They had a great result. Eli Lilly was one of the few pharmaceutical companies to have a big run up. And Bombardier, surprisingly, has come back. If you drive out towards Costco here in the Western District, you'll see that there's a freight yard there for Bombardier. But if you look at the names on the trams, I think you'll find a lot of the trams are made by Bombardier. So not only do they make airplanes, but they make trams as well. To the downside, at I want to focus on Royal Caribbean. I just think these companies that are in the hotel business or in the cruise ship business are still very vulnerable to running out of money before things open up. Now, of course, a lot of people in the U.S. have had the virus. A lot of people have recovered. People have worked here previously and have gone back to the States, have had it. They've been vaccinated, and they're starting to get through the curve where there is some herd immunity. But it's not by any means giving an open up for the hotel groups or the cruise lines where you might be taking somebody from the United States. Are certainly not coming to Australia. So the cruise business is still at very high risk. Also to the downside, kind of surprisingly, was Deutsche Bank, because they had a big increase in the profit forecasts for the following year, some 100% increase in profits for the next year. That wasn't enough for the market. You can see here on the graph on the right, which goes vertical, that's the percentage change in earnings estimates. And I'm going to go to the next slide here and say that the relative value model shows a scale on the left side, which is the price of each sector on average to the sales. So you have a price scale on the left, and you have an earnings scale along the bottom. Do we have a question, John? And so the slope here, the line through the middle, is the price earnings ratio. So what happens is the prices go up and down, and the earnings go right and left. Yeah, BlackBerry is coming off a very low base, but BlackBerry I thought was going to be done. It's not something we follow closely enough to really know the detail on, but yes, it's coming off a very low base, and it's more in there for us to monitor on a relative basis rather than to be interested in. In the relative value, I want to point out the FANGs here have a very, very high price earnings ratio, and pharmaceuticals make a bigger profit margin, but have a much lower price earnings ratio. And that would imply that pharmaceuticals have no growth, high margins, but no growth. In fact, they often have patent cliffs and negative growth, whereas the biotechs have even bigger margins with more stocks in FDA approval processes and the potential for drugs to come online, but they don't have the patent cliff, and they have still a price earnings ratio that's almost in line with the industry, whereas software, semiconductors, and FANGs have very high price earnings ratios and high margins. Then when you come all the way down here to lodging, hotels, they are at a very high price earnings ratio because they're not making any money. And normally, this is saying normally you'd expect them not to have a return on sales of 5%, but you'd expect them to have a return on sales of about 15%. And I don't think that's sustainable. Now, this lodging and restaurants has some profitable restaurant companies in there. Chipotle and Brinkers are doing, Chipotle in particular is doing very well. So that drags the price earnings ratio up. What we're seeing here is earnings estimates going up across oil, very significantly, big increase in oil prices. And in the stocks, what we're seeing, the price action here in the, Kelly? Big movement in the FANG stocks. And we need to lower the state one. So, so we're seeing, not really any rotation up in any particular sector. It's not like we're seeing, well, we are. In fact, the consumer products in the food sector had run their course and are now flat. And we're continuing to see advancement with great results out of Google and Amazon and companies that are supplying chips to them. And so the semiconductor sector and anything technology related continues to capture more economic activity. In a macro sense, we have a question, Kelly, over to you. Thanks for asking questions. Could you enlarge the video of Joe and the team? Well, we want people to see the slide deck. I don't know how it shows, Mike. And Tim, I know you're a Harley rider, and no, I'm not going to comment on the Hogs, but they're, it's a great company, does very well, but I'm not sure why they were down so much. I haven't followed it that closely. I'm sorry, Tim. Mike, I'm sorry, but this time we'll have a look at how it appears later. But for this stage, I think we want to be able to allow people to read the slides. In 3Q, when we did the earnings review, we focused on the three uncertainties of fiscal stimulus, COVID, and the election. And since then, risk has fallen and the market has risen. Interestingly, as I mentioned, a lot of companies are providing very, very large surprises. So if a company beats, it beats by a lot. And if it misses by a lot. And so the bell curve around the earnings results is very, very large and skewed very far to the right, because the earnings came in way ahead of expectations. Typically, in what I would call normal times, throughout the 90s or 2000s, you'd have about 70% of companies beating, 15% missing, and 5% matching expectations. But we're way up at the 81%, so companies are really outperforming expectations by a wide margin, and Wall Street's just got it wrong, as companies make a lot of money. 15% missed, and 3.4% matched expectations. As I said, the curve was skewed way to the right. Ford beat by 590%. Now, we expect Ford and General Motors and car companies with the wide variables going into it to have very unpredictable earnings and low price earnings ratios. By the way, I'm going to sidetrack here for a moment, and it's not a joke, but this is fascinating that Tesla has bought $1.5 billion worth of Bitcoin and are going to now start accepting Bitcoin to purchase Teslas. So the joke in the office is that all those drug dealers with all the Bitcoin that they got on the dark net are going to be lining up to buy Teslas. So who's driving a Tesla now? They'll be driving across the Mexican border. That's probably some truth to that. We laugh, but there's probably some truth. So people who are dealing in the dark net, who are loaded up on Bitcoin, don't know how to spend the money, will probably all go buy Teslas now, right? I mean, it just makes sense. So that's what's going to happen. News Corp up. What did I do there? News Corp, they beat by 200%. T-Mobile, which just merged, up a beat by 100%. Amazon, keep in mind, Amazon Web Services makes most of the money, and most of Amazon businesses run at cost, like Costco. But Corteva, very interesting. Remember, DuPont and Dow merged and spun out their seed and genetically modified seed and chemical business into Corteva, and they killed it this quarter, which was just really good to see. And it's a stock that we're interested in watching Bayer as well in Germany, where, of course, they bought Monsanto and had to settle with some very big numbers. It was a disastrous acquisition for them buying Monsanto, but the settlement of cancer-related to seeds that they had sold, it now seems to be behind them, and I think they are something interesting to look at. Goldman Sachs beating by 65%, so some very, very large beats there. Kelly, I can't see this question, so you just tell me. There is, right? So repeat the question. Tim, who rides at Harley, wants to know if I have any comments on Harley Davidson and John says, what do you think of the risk of tether? Oh, well, yes, it is, John, it's not something for the subject here today. I was a very, very early adopter in Bitcoin and in blockchain. I never really got into altcoins. I was much more interested in the application of the blockchain to transfer assets. And so trying to understand the value of Tether or Bitcoin, I would say I know a lot about it, but it's not the place for it here, and maybe we should go to lunch, okay? But I am a big fan of the blockchain. And you know, my LinkedIn profile says that I think that the blockchain is the most important technology ever, much more important than the internet, because the internet allows people to share information, the blockchain allows people to share value. And I think that, you know, just on this track for a moment here, John, Facebook got it totally wrong when they announced their Libra, which is now called Diem. Yeah, Diem. And what they should be doing is paying people microcoin, Facebook coin, for making a post that gets attraction. So it would turn the, there's an expression that says, if you're not paying for it, you are the product. In other words, if you're posting on Facebook, if you're posting on Reddit, if you're posting in YouTube, and what you should be able to do with the blockchain technology is give people a YouTube coin, a Facebook coin, or a Reddit coin, and you can make micro payments very cheap for how many hits and how much who's paying for lunch? Okay, John, let's get on with the presentation. We'll talk about that later. So there's a very interesting blockchain business called Steemit, and that's their strategy. It says that if you post something on Facebook and you get hits, then you get a Facebook coin, and that can accumulate and be traded in. So that would turn the internet and monetize the internet with micropayments and turns the whole model upside down. President Biden is pushing forward on this $1.9 trillion stimulus package. I think the big question is, where's the money going to come from? And we've, you know, talked a lot about the debt that exists in the world. I personally have never liked to take on personal debt. I took on some college debt. I saved before I bought a house. I think debt is, but the government, of course, wants us all to borrow money. And the government is borrowing vast amounts of money and they're paying almost nothing for it. If interest rates go up, a lot of people could be in deep trouble. So they are borrowing 1.9 trillion. Stimulus, the $1,400 checks will go out to people who are not likely to save the money, is the way they're putting it. So if a couple is making more than $150,000, they won't get a check because those people are more likely to save the money, and they don't want savers, they want spenders. So it's counterintuitive to my personal fiscal responsibility. The recovery, as I said earlier, faded in December as the stimulus package ran its course. Biden's is yet to take effect. And in Amazon and Apple, they have blowout quarters. Bezos is stepping back. It's sort of trendy, you know, with Bill Gates starting that step back, with other executives from large IT companies stepping back. But he's not going to leave. He's handing over the reins of the CEO position to, I can't say his name, Jazzy? What is it? Jazzy, yeah, like, yeah. Jazzy, okay, so, but he comes up through the web services division. Now, of course, the Microsoft promote and the Google promote were both, all three of these are people coming up through the web and the cloud part of the business. So I say it's a cloud of steam at the moment. It's really hot getting into the cloud space. Technology spending caused a severe shortage in chips, and the auto companies weren't prepared for it. They usually are very good at supply chain management, but there are not enough chips to put into the cars. And so Ford, even though they had a blowout quarter, had to cut estimates for next year by, was it $1 billion or $2.5 billion, because they can't get chips to put into the cars. Right? Was it 1.5 billion was the potential write-off? But this is resulting in some big changes in Taiwan too. And I want to, you know, we emphasized last month that Taiwan is probably the friction point in the world right now because China is circling them, and we said that they fly the planes around, and then Taiwan has to launch planes in defense, and they're not recognized by most countries in the United Nations. None of them, only one country in Europe recognizes them, that's the Vatican, but they're at risk. But there's a representation that the U.S. or an expectation that the United States would defend them. Now, with what's going on in Hong Kong, China wants Taiwan. They want control over Taiwan. They want control, and I think this this coup in Myanmar, the Chinese are behind that because they want the Belt and Road, they want the direct route to the Indian Ocean, and they're working with the people in Pakistan to get direct routes there. So they have big long-term goals, and Taiwan is part of it. So they will test Biden. But right now, Taiwan is very important because Taiwan Semiconductor makes most of the chips in the world, and they stopped selling to China, which is putting immense pressure on China to come up with their own chips. And they are notorious for stealing IP, so the pressure is on for them to steal IP and make their own chips. And Andrew will probably tell you it's not as easy as stealing IP and making chips, but they're pretty good at fakes there, which is one of the reasons Trump was trying to hold accountable. Biden's top priority is COVID. Now, I don't know what he's going to do that wasn't already set up by already set up by Trump, but I guess he's going to tell people to social distance and wear masks. I don't see his top priority as being anything that is due to him. And after getting vaccinated, people are going to start going out again. So I think more people showed up to the Super Bowl. Steve, your sister went to the Super Bowl? Yeah, 20,000+ people. 20,000 people there? Did you get COVID?
I don't know, but I think it's possible. I mean, it was a super spreader event.
It sounds like a super spreader event. Yeah. So, Mario Draghi is trying to create a new government in Italy. That's very important. Italy has a different sort of economy because not everyone engages in the tax system, and there are a lot of small family-owned businesses and they're regional. And for them to really consume IT, there needs to be a lot of consolidation and some bigger companies created. So I'm not sure that Italy is going to be as successful as Germany or France or England in this new economy. There would need to be a lot of consolidation. The same problem exists, of course, in what they call the pigs. That's Portugal, the Iberian pigs. Portugal, not Ireland. Ireland is good with everything else, but Spain and Greece in particular. They need structural reform in addition to fiscal stimulus in Italy because it's skewed towards family businesses. And then, of course, the Chinese New Year celebrations start on Friday. The IPO market in Hong Kong has been gigantic, even with Ant pulling out. And what's happening with Ma is frightening, but everything is just going ahead. Jack Ma. So would somebody like to explain what's going on with Jack Ma so I can let someone else speak for a moment? We'd like to talk about Jack Ma's circumstances. Andrew.
I can add that comment. So we talked about Alibaba and Jack Ma at the December presentation. And of course, Ant Group was filing for one of the biggest IPOs of all time, and Alibaba have got a 33% stake. Jack Ma made some comments which upset the financial regulators, and it was to do with the financial regulatory system. Shortly thereafter, the IPO was placed on hold, and Jack Ma went missing for about a month and a half. And so he, in our opinion, has been reformed, if you like, and we do expect Jack Ma will make appearances, and that will help the bullish case on Alibaba as a standalone investment. But the regulatory reform in China, in the fintech space particularly, has been very aggressive, and there is a restructuring taking place. So we'd expect an Ant Group IPO to come back on the table.
So I don't think Jack Ma's made one sort of programmed appearance. Doesn't seem to be a lot of free speaking in it, but we're very concerned that China is going to take the richest guy in China and take him in for reprogramming. It's a concerning trend, but the market's just looking right past it. Now, Richard, oil is up. Well, where does sales and production sit compared to the pandemic? No, we're nowhere near back to business as usual, Richard, nowhere near. I say that Exxon is firing on no cylinders. So just a big overview of oil, and we'll go into Exxon in a little more detail later, but OPEC is a group of countries that controls about 80% of the world's oil reserves, but they produce about 40% of the barrels per day. And so if they decide that they want to increase or reduce production, they influence the prices. Now, when oil prices, what a company like Exxon does, first of all, is they go out looking for oil. You know, they punch holes in the ground. That's exploration and production. And if they find the oil, they pump it. They have to transport it. Now, when you transport it, it can go through a pipe or through a big ship, super tanker. And so the second part of the business is transportation. The third part of the business is the consumption of oil. So when oil prices go down, their refining and chemical business has lower costs, and they can potentially be more profitable. So if you're refining oil, it gets refined, you basically boil it, and you get the fuel for airplanes at the top, the light stuff, and then the heavier stuff with gasoline and diesel, and then it gets heavier and heavier. You have stuff that goes into making plastics, and then finally into the tar for the roads. So in these refineries, or in plastic companies, they're going to consume oil, and they're going to process. It's going to be subject to supply and demand. And if you're making plastic that's going into sewage pipes like PVC, it depends on government infrastructure programs. So what I'm trying to say here is that Exxon has about 5 or 6. And then there's distribution. So you go to the pump and you buy the stuff at the pump, and you buy a Mars bar, right? So the question becomes, when oil falls, will refining improve? And there's a bunch of different layers to the impact on earnings for any of these big multinational oil companies such as BP, Exxon, Chevron, or Shell. And right now they're firing on no cylinders. They're not making money in any division. Even at the pump, now in Melbourne, we're paying what we used to pay, because most of what we pay for a liter of fuel here in Melbourne has nothing to do with the price of oil. It's just a government tax to fund the roads. So now Tim's saying Exxon, they're closing their Altona refinery. Well, why doesn't that surprise me? This will reduce the cost. No, well, it has not. The Altona refinery is not going to have any impact on Exxon because they're just too insignificant. It's like Ford not making cars. I mean, the reason that we have a refinery in Altona is because Australia wants independent sources of oil, independent source of making cars or tanks if they need them in a war, or they need an independent airline so that they own their own airline. So countries like to make their own food. So this refinery in Altona has no longer become a government strategic asset, and that's why it's closing, and the government isn't willing to support it anymore. It has a lot less to do. Manufacturing in Australia is not profitable. So I don't think it has anything to do with anything other than a government strategic initiative. That's pretty cynical, but it's probably not far from the truth. Thanks. Let me let someone else talk about banks for a while. Chris, do you want to talk about banks?
Thank you. So start discussing some of the earnings that were released by stocks in the relative value portfolio. And the banks had a very good quarterly earnings season. Both the Main Street divisions of banks, the lending businesses, have benefited from very conservative provisionings earlier in financial year, in the early stages of the pandemic, and then they've been able to release some of those loan loss reserves. But for the Wall Street style banks that make money from providing trading and corporate advice, investment banking advice, it was really an ideal environment. And Goldman Sachs' results exemplified that. They just benefited across the board from the volatility in asset prices, which drove Overall revenue for the year up 22%. And some of the highlights were investment banking, where revenue was up 26%. I think trading division for fixed income, currencies and commodities was something like 40% higher. And that's helped catalyze the stock to new highs around the $300 level. And they continue to make headway with their new strategy under CEO David Solomon to diversify the business to be a little bit more consumer oriented. And the rationale is to make the business a little bit more, the financial results a little bit more consistent and predictable, rather than the boom bust, which is associated with those Wall Street style divisions. And they continue to attract assets in their markets division, and they're one of the few banks that actually increased their loan loss provisions, because that is that lending arm is something that they're growing, but also something where they had very little exposure early on in the pandemic, which was fortuitous. My hand to Joe to discuss the consumer product.
Well, I think, Chris, there's not much to say about consumer products and food, except that they went for a big run in the second quarter on the what we call the clicks and snacks trend. So we saw people sitting at home eating cheese and crackers and getting drunk. And so Louis Vuitton did well, beer companies did well, wine companies did well, and consumer product Clorox did well. But in the current period, that upward trend, which somebody like Kraft would say, oh, this is sustainable. People are going to keep staying at home eating cheese and crackers. Was nice try at the time, guys, but everything's been flat since then. So there's really just flatness in consumer products, which had held pretty tough during the second and third quarter. Food, there was Coke, which we own, and Steve, going to talk about Coke?
I think we're going to touch on Coke.
But I'll just say what we're going to say, and then Chris can say it. But half of their earnings come direct from consumer, and half of their earnings come from outside the U.S. So if you solve COVID in the U.S., you only solve half of Coke's problem.
Thanks. So Coca-Cola will report earnings this evening, and it's something of a reopening or reflation investment thesis. We saw early in the pandemic that unit volumes were down 25%. That was in April. And for the third quarter, they've recovered to be within 4% of the previous year. So when they report earnings, our focus will be on the organic sales and the continued recovery, also the guidance that management provide, and finally the transfer pricing liability or potential liability that management will be provisioning for. So in November, Coca-Cola had an adverse tax ruling with regards to disputed tax over their transfer pricing, and the liability could run as much as about $3.5 billion for the 3 years that were in question. I think 07, 08, and 09, but it has implications for their transfer pricing and business practices, and therefore tax in subsequent years. So Coca-Cola has appointed new legal counsel in early January, but this adds some uncertainty to the investment thesis and the outlook. But I think it's something that Coca-Cola can address by modifying their distribution model and their transfer pricing arrangements with local subsidiaries and bottlers, which are now largely off balance sheet. So that'll be the focus with the result this evening, and we'll communicate an update on the company tomorrow morning.
What's the next slide?
Thanks, Tony.
I'll take on Viacom.
Good.
Yes, please. Yeah, so Viacom will report on February 24th, so we're a couple of weeks, well, a week and a half away. but some of their competitors have reported. Activision Blizzard was up 30%. They had a pretty good result last week, and Take-Two reported on Thursday with another excellent result. Let me just jump ahead to Viacom. So this price momentum has been interesting to us. The shares have risen 54% since November. Now, part of that is just a multiple expansion. We went from 6 times earnings to 13 times earnings where we are now. However, 23% of the stock, or the outstanding shares, the float, is currently being shorted. And what can occur, and we saw it in a very big way with GameStop, but in a smaller way, I think perhaps with Viacom, as shares begin to rise, it becomes a sort of feedback loop for these short sellers who are ultimately forced to cover their positions if they lose enough money. And the problem with shorting the stock is that your potential loss is infinite. It could, theoretically. So we've seen this short squeeze occur in a number of equities across the market, and AMC maybe has, from our perspective, benefited from that. But other than that, going to the fundamentals, what we've seen at the company level is a much more organized or less dramatic corporate suite, with Shari taking the reins. Some are passing away, a very clear management hierarchy. Things seem to be much more focused on the business, and they're making real inroads with streaming, and so that would be, I think, what analysts are focused on during the earnings result. EA had pretty good earnings. They met the revenue estimates, and they beat on an earnings per share basis by about 4%, but they guided lower for the upcoming quarter. They're going to earn $1.98, and that is about, I think 10% below what the expectations were. And the reason for that, they have cited, and this is really one of the first companies that we've noticed using the work-at-home costs as, well, maybe an excuse for guiding lower on an EPS basis. But they say that the work-at-home cost is going to hurt earnings in the next quarter. So the shares saw some profit taking, but we've seen a bit of a recovery since they announced their results last week. I think it was last week. Pharmaceuticals.
I just want to make a general philosophical comment, Steve. I want to talk a little bit about ethical investing, because I couldn't buy personally a company that's in the gaming business like Crown Casino, and I couldn't buy a tobacco company. And we've had some ethical pushback on the recommendation for Exxon, which I found very surprising. Let me say that I think Electronic Arts is a much more ethical dilemma problem stock for me than ExxonMobil. I don't have the same ethical dilemma on Exxon. But Electronic Arts, what they're really doing is using the same sort of psychological techniques that a gambling company would use to get, kids into that frame of mind. So I just wanted to briefly touch on the ethical dilemma that some of you have mentioned about Exxon, and it's not nearly as big a problem for me as Electronic Arts.
Thanks, Joe. Food for thought. So pharmaceuticals, a pretty flat 2-month period overall. We had a profitable trade in Amgen. We invested shortly before some of the COVID vaccines were approved, and the stock had really languished because they didn't have any promising candidates. And so while investors were all focused on drug companies with the most promising candidates, Amgen appeared overlooked, and it was a pretty, I think, classic relative value sort of opportunity, and we capitalized on that, generating a decent return over 4 months. The other drug company that we own is Viatris. They'll report later in February, and this will be the first quarterly result post the merger of Mylan with Pfizer's generic business called Upjohn. And shortly after the results, they'll host an investor day, so the guidance may be a little bit light when they report the results as they prepare for the investor day on the 1st of March. Stock's trading at less than 5 times forecast 2021 earnings, and really we want to see progress towards the various KPIs or the rationale for the merger in the first place. There's significant cost synergies, probably one of the most significant components. Cost synergies expected to run at about $1 billion, accruing per annum, but accruing or building towards that over a couple of years, and also a commitment to a dividend payout of something around the 25% of free cash flow. So there's some items we'll focus on when they report earnings later this month. Two other healthcare stocks beyond pharmaceuticals. This is also a sector that's benefiting from the anticipated reopening, especially the resumption of elective surgeries. Our investment in Medtronic is very sensitive to that thing. They also report.
I'd like Steve to make the cultural distinction between California and Texas, because it's actually interesting, and it is part of understanding American investments. But Steve, would you comment on Texas versus California?
Well, you know, as Joe wrote in the report, Tenet Healthcare, which is based in Dallas, their prayers were answered. And, you know, as a Dallas-based company, that's pretty consistent with Texas being viewed as a Christian Republican state, while California, on the other hand, puts more faith in technology and maybe, I don't know, quote unquote, science, and is typically a democratic state. But what we've seen in
Notoriously democratic, not typically. Notoriously democratic.
Yes, the Democrats have really controlled the state since the mid-90s. Now, there were some interruptions with Arnold Schwarzenegger, who is a Republican, and Ronald Reagan and Pete Wilson. So California, somewhat like Massachusetts, has had a history of being controlled by the Democrats, but sometimes electing a Republican governor. But nevertheless, what we're seeing is a huge exodus of people from California to Texas and Florida, where there is no state income tax. And it's arguably a little freer in Texas and Florida, or just costs a hell of a lot less to live there.
I don't mean to brag, but I am. I went to California. Nancy Pelosi, of course, is from California. She's a Democrat, and I had the good fortune to spend New Year's Eve with her last year. So that was fun.
Nancy Pelosi is 80 years old and looks great, as Trump would say, for her age, I'd say.
Nancy Pelosi is a strong Democratic ideal person from San Francisco.
Yeah.
And so is our vice president.
Yes, yeah, prototypical Californian politicians.
Kamala Harris.
Yeah.
Sorry, we had time for that today. Thank you.
Yeah. Well, let's do a few more earnings to cover. Yes, so Medtronic has a different fiscal year to most stocks. Their third quarter result will be later in the month, and our focus again will be this reopening theme and the extent to which the deferred revenue will be realised over the following few quarters. There's been fits and starts with regard to the reopening, particularly with the spike in infections, which has still weighed on the resumption of these elective surgeries. But I point out that Medtronic is a very high quality business. It's still retained its premium price earnings valuation, which reflects that, and has a fantastic balance sheet. They actually continue to invest heavily in R&D. They haven't curtailed any of that during the pandemic, and they raised their dividend as well. So all a reflection of the quality balance sheet, which enables them to coast through this pandemic. I might hand to Steve to cover some software.
Okay. As Joe mentioned, Baidu is up Well, now it's 93%, I think, since the start of December.
Same night last night, yeah.
Yeah, another 10% jump last night. Alphabet reported excellent earnings, and we've seen analyst revisions up, raising the price target to an average of 2,300 per share across. There are about 37 analysts who cover it, so we've seen a pretty swift upgrade across that analyst community. The highlights of the results, I think, firstly, were the YouTube numbers. So ad sales on YouTube grew by 46%, well ahead of expectations. In the previous quarter, they grew by about 30%. Across company-wide, sales grew by 23.4%. Ex traffic acquisition costs, the total sales were about $56 billion. It's trading about 23 times earnings, and it continues to grow at a mid-20s compound annual growth rate, which we think is a pretty reasonable multiple. They've also added a huge amount of cash to their balance sheet. They have $136 billion in cash, about $110 billion in net cash, which they'll be deploying in buybacks. But across the board, it was a great result. The new aspect of their reporting this quarter was that they broke out their cloud division sales, which were ahead of expectations. They had $3.6 billion in cloud sales, and I think the expectation was $3.4 billion. But what surprised a lot of analysts is that they're actually losing money in that division as they spend to gain market share. Amazon remains the dominant cloud services business in the world. I think they have about 40% market share, and hopefully these investments by Google will pay off. We'll see. But it's so inconsequential to the broader business that analysts look past that. Any comments on Alphabet?
Yeah, how long have we owned it? About 10 years? We've owned it about 6 years?
June 2015.
And we're just holders on that. That is a great company, and we're holders.
Yeah, still looks to be pretty good value. Qualcomm reported decent results. They had about 29% sales growth. However, the shares were sold off, I think, on some strength. But the company did guide cautiously for 2021 with respect to the supply of chips in the world. There's currently there's a supply shortage, and that, similar to Ford, could impact sales. However, they're committed to $8 billion in free cash flow, and they, with their current guidance, are expecting 30% sales growth for the whole of 2021. And that's really driven by this 5G super cycle, which we're just entering right now. Qualcomm will be the primary provider of technology into 5G infrastructure in the developed world, or maybe I should say the Western world, in US and allied countries. And on 5G capable handsets, Qualcomm makes about 40% more in profit than on 4G capable handsets. So this is a long rollout, which suggests a continued long runway for Qualcomm growth. And it's about 17 times earnings, which we think is a very reasonable multiple given a 30% sales growth projection for this year. I'll hand it to Chris to talk about Exxon.
Thanks, Dave. So the newest addition to the relative value portfolio, we recommend Exxon as the effectively the 9th relative value holding, replacing Amgen, which we sold a couple of weeks ago. And I'll try and address Richard's question with regards to the production recovery. Exxon's 2022 revenue is forecast to be within about 5% or less than 5% of the level that they achieved in 2019. But profitability is actually forecast to be about 30% higher than the 2019 level. So that is a reflection of not only the underlying oil demand close to pre-pandemic levels, but also a lot of the management initiatives to reduce costs, divestments and CapEx cuts, which will not only improve the profitability, but have enabled management to reiterate the most recent results last week, their commitment to the dividend, which there's been ongoing conjecture around the sustainability and whether management would maintain their commitment to that high dividend, one of the highest in the market at the moment at around 7%. So with the stock still around $50 versus a pre-pandemic price of $60, plus the dividend, we think that's a compelling investment proposition. So in summary, the relative value portfolio now comprises 9 stocks, which just highlight that we divested Amgen, so we do have a portion cash, and a couple of supplementaries.
And a great recent result. So we're happy to be making you money. We want to make your friends money too. So we've been able to keep the content down to an hour. You know, a lot of times I just cram too much information in, so I'm going to take a bit of credit for finishing on time today. And but we're happy to stick around and answer questions. So it is much harder. I'm going to say it is much harder to do this to a screen than to have you sitting in front of me, because when one of you in particular starts like nodding off a little bit, you know I can see you, and I can, you know, focus on what you're interested in, and bring you back into the conversation. It's a lot harder doing it to a screen. So we're really looking forward to you know, opening up the office and having everyone back in. Nancy, what's that, Michael? Nancy's biography, tough and effective. Nancy Pelosi, yes. So we went to, I spent New Year's Eve with her, and it was a small group of 200 people. So me and Nancy and George Schultz was there. And I could tell you some stories about George Schultz. My father used to work for Bechtel. They used to produce power plants. Built power plants all around the world, and George Schultz was the head of Bechtel, and he went on to become Secretary of State under Reagan. Was it Reagan or after Reagan? Bush was, yeah. Anyway, that concludes our presentation today. Any more questions? No?
No.
Well, thank you very much for attending, and we look forward to seeing you in the office soon.
So listeners with additional questions can contact myself or the team by phone or email as per the contact information on our website. So that concludes our presentation today. Thank you all for joining. Stay safe, everybody, and we look forward to speaking with you again. You may now disconnect.
How electronic arts, are we still on?
Yes.
Oh, how electronic arts costs increase due to staying at home. They've had to provide stipends or benefits. So if somebody is working from home, they've had to arrange, they've had to give them extra pay to be at home. Now, I hadn't gone into any more detail on it than that. Has anyone looked at it in more detail than that?
It's also the setup costs for the home office with the technology.
Yeah. So setup costs for home technology. So we'll have to have a closer look at that. But it's the first time I've heard anyone say that. Did we have increased costs? I mean, I think the people here, we picked up our computers and we carried them home. And I think that a lot of people in New York are concerned about whether they're paying New York employment taxes or not. So there's a big question there, but I think now everybody should be taking tax deductions for the percentage of their home that's being used for business. So it should actually benefit them for having a home office and working from home, because they'll get to deduct some of their mortgage or some of their whatever. So, but I'm not giving them extra money. Don't give them any ideas. Okay, thank you. I don't mind, Mike, I don't mind buying sandwiches and drinks for people, you know. We're happy to do that. So. nice to see you. But I know, Mike, you're having a pie party coming up, so I'll have to try and register.
All right, that's it.
Thank you, everyone.
Thank you.
Thank you.